Thanks again, Laura, and welcome to our panelists. It is really a privilege to moderate this panel of very esteemed global experts in ESG. In putting in a bit of a plug for gender diversity here, I'm delighted to have 3 women on the stage, and I also will note we have 3 Aussies on stage, so that's a good thing too. So just to get our polling started, you can see the question on the screen. Which best represents your use of ESG information in your investment process? So this is interesting, and I think bears out to some of the conversations we were having with the panelists ahead of time. There's a lot of folks that are still exploring the use of ESG data. I think that was pretty consistent with the views that we were thinking about. And then really on the opposite end of that, I think a lot of people in the room that are really focusing on improving investment results with ESG. Okay, let's leave that there and let's go to the next question. Because there obviously is a lot of activity in ESG, as you can see from that. Which type of ESG data are you using? Is it A, environmental, B, social, C, governance, or D, all of the above? Wow. So there's definitely a pretty broad portfolio of ESG activities happening here in Asia. Right, across the entire spectrum. All right, so let's get started. I really want to kick off and hear from everybody to begin with. So as many of us know, the number of UN PRI signatories has grown from 100 to over 1,800 asset owners and investment managers, collectively managing over 70 trillion of assets, committed to incorporate ESG issues into their investment analysis and decision-making process. To the panel, from your perspective, Asia obviously is a big region. Certainly we know Australia is doing a lot and at the forefront of ESG investing. How would you, if you were to take a pulse and describe what's going on in this region, how would you describe ESG investing here, the difference across Asia and the difference to what you see in the rest of the world? Why don't we start with you, Pru?
Well, thanks very much, Deborah. I head up what's called Investment Stewardship at Blackrock. I'm part of a global team of 35, and that's actually growing to 65 over the next 2 years. And I think that demonstrates the value that BlackRock puts and the importance that BlackRock puts on the function of our team. And what the team does is it sits on top of all the investment strategies. As I think everybody in here knows, BlackRock is a large asset manager. We've got funds, active funds, we've got passive, we've got quant. In fact, if you think of an investment strategy, I'm sure there's a BlackRock product that covers that strategy. The bulk of our investments are passive, so we work with the fundamental active equity analysts in our work. We vote at meetings. It's the broadest form of engagement that we have with companies, so that's globally. And we also engage with companies, and in particular we focus our engagement on boards on ESG issues. And as Debra said, Asia's not a homogeneous environment. Australia is a very mature market. Our engagement with Australian companies is generally with the chairman of the risk committee, if it's around environmental issues, or remuneration audit, depending what the particular issue is. We have very good access. All asset managers, in fact, in Australia have very good access to boards. Now, we look at ESG as part of the investment process, that if these issues are managed well, that it should contribute to longer-term sustainable returns. When there's a breakdown in the management of environmental or social issues, it can have catastrophic impacts on company performance. If you look back at the Rana Plaza situation of a few years ago, there are certain brands that were linked with that. If that situation were to happen again and those brands were identified for a second time as being involved in that, given the level of communication with technology these days, their share price would probably more than half overnight. So it's important that the companies we invest in understand what risks they are exposed to and that they are managing them well. In Asia, unfortunately, governance is seen as a compliance issue. When we have conversations with company, it's about complying this. Yes, we have a third of the board independent. We have an audit committee. We have tick, 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 tick. The conversations that we have with Asian boards is that this is a strategic issue, that having the right people on the board, having competent directors, not just independent directors. Some of the most competent directors I've met in Asia are technically not independent, and some of the most incompetent directors I have met are technically independent. So we're not just focused on tick-the-box approach. And it's about having competent directors, and because often our investments are passive in nature, we have an alignment with, well, we've got block shareholders here, family and state, because we can't sell. So the story and the discussions we have, that we're here for the longer term, we're a patient capital, we'd like to see change, we want to see more transparency around the board, we want to see more competent directors. We have a saying that in particularly around Hong Kong, China, etc., that even though someone's classified technically as independent, no director's independent until proven otherwise, because of the influence of the block shareholder. And so we're obviously using company information, external data providers to really build a picture around how we see that company from an ESG perspective.
Thanks, Pru. Emily, you have a different vantage point on the ESG space. So from your role leading research and integration around ESG with an asset manager, what's your view of the Asian landscape, both within and comparatively globally?
Sure, thank you, Deb. It's a pleasure to be here this morning. I'm the head of ESG research and integration at Manulife Asset Management. We are a global third-party asset manager within the Manulife Group, and we have extensive operations in various Asian markets. And I would agree with Pru's observation that Asia is not homogeneous in any sense. And so when we look at the state of ESG integration and practice, it is very market specific. With that said, I think we can safely say that for the most part, on average, ESG integration practices remain behind in Asia. They're not as advanced as you would find in other markets, particularly Europe. Australia is quite advanced, almost like a completely different type of market, I would say, to the rest of East and Southeast Asia. Japan is probably the market where we're seeing the fastest uptake and more sophistication of practice among the asset management community, very much driven by the GPIF and the asset owner community in that market. And then what we're seeing in other markets like Malaysia, Singapore, Korea, and also in China is more and more interest in what is this space about, how can we use ESG data to enhance long-term returns. And that's particularly the concern from asset owners in this region who are starting to link their very long-term time horizon with the materiality of very long-term ESG issues such as climate change, such as demographic shifts, and such as disruption. ESG data is very much at an early stage as an industry globally. The ESG data we get in Asia, based on company disclosure, is also rudimentary sometimes, and sometimes just non-existent. And so there's certainly a long way to go for those data, the quality of those data sources that drive this space certainly need to improve. But with that said, it is rapidly becoming more and more available. And I think the asset owners in this region are starting to link how can we use this data to help us manage our long-term liabilities.
Thank you. So you talked a lot about data, and I really have to jump in on you, Stephen. Stephen Malinak is formerly one of our Thomson, or is a Thomson Reuters alum, and now part of our partner network working with TruValue Labs. But Stephen is a world expert in data and the application of data to the investment process. Just interested in your views in terms of as we look at Asia compared to the rest of the world, from the data perspective, and I know you travel a ton all over the world, how do you see the development and the maturity of the markets within Asia from sort of a data and analytics perspective?
Again, I'll agree with everybody else. There's big differences as you go around to different places. Each has its own challenges. But also the upside of a portfolio strategy across Asia is you have so many different markets from developed to emerging and frontier. They're not as heavily correlated with each other as you see within the United States or within Europe. So this provides a real opportunity. A lot of it is there's just lack of coverage, so you need new ways of getting at small cap Australian securities, getting the native language processing to get text mining working in Japan or in China. And that's starting to happen right now. We've got these real breakthroughs. The computers can learn Japanese and Mandarin just like the humans can, and they're starting to catch up with people. And as we look at what data you need to know, the traditional data sources only explain about 15% of what is going on. And when you look at your quant models, you see, yeah, that's about the information coefficient you're getting out of all of your quant factors. That means that 85% of what is going on is basically everything else. So environmental, social, and governments are big pieces of those, but it's also a broader piece of intangible risk. All these things that can come out of nowhere. Data security and privacy is a huge one that's going on. That's partly ESG and partly an issue of its own. But we also see there's upside potential from these as well. These aren't just risk factors, but if you see people who are making improvements in these areas, they can make long-term sustainable changes. And this is why we see asset owners coming on board saying, hey, we really need more data. We need full coverage of our market. We need to rethink how we're building some of these indices so that we can put capital toward where we want it to go and not necessarily be locked in with the way that things were in the past.
Thanks, Stephen. And so lastly, in terms of just an opening perspective, Francois, again, a different perspective as a portfolio manager with East Capital, and you've been, as I understand it, looking at ESG investing for quite a long time, 18 years, I believe. What's your perspective, and also how have you seen the acceleration of change, or have you seen the acceleration of change?
Good morning. It's been an interesting journey for ESG in Asia and ESG integration. When you look back at how Europe started, end of the 90s, beginning of 2000, at that time, we really needed one large asset owner, institutional investor to kick off the process. And in France, typically, we had the Fonds de Réserve des Retraites. In the UK, we had a number of public pension funds moving. And it's really what was the key core driver of ESG integration and sharp rise of AUM in Europe. Where do we stand in that process in Asia? Over the last 10 years that I'm working on ESG in Asia, we've been hearing more or less the same type of speech. Yes, we'll do it. Yes, maybe next year. Yes, it will start soon. Yes, we need more data. So it's maybe time to start for Asia. And the beauty of Asia is that we are at really the core of a number of mega trends shaping the future of the world in terms of population, in terms of economic growth, in terms of potential environmental impact, etc. The contribution of Asia is major, and the solutions coming from Asia are also very interesting. So when it comes to ESG integration in Asia, for a very long time, the lack of institutional investor involvement and the lack of data have been perceived as major constraint, but I think that going forward, with a number of recent developments, it can be Japan, but it will also be in China very soon, we will see ESG integration moving forward at a very fast pace, catching up with Europe, I would say.
So let's stay with you, Francois. It's like ESG, I think, means, and please, I invite the other panelists to jump in on any of this, but ESG means different things to different people. And so the question is, what's driving ESG adoption across the buy side in Asia? Is there a right strategy? Do you think that the buy side should be offering more solutions-oriented investment products around climate change, gun control, or whatever it might be? Is there such a thing as a right strategy here in Asia?
I think you need both. And at the end of the day, a client will determine what you can push and what you can sell. So one of the key implications of that is you need some flexibility. When you deal with, in Europe, we used to deal with German clients, very ethical-oriented type of approach. When you look at what was going on in the US, in fact, sometimes very similar. When you look at France, when you look at Spain, when you look at Italy or Nordics, very different approaches. But we are still talking about exactly the same companies as a portfolio manager when you invest in. So implications in terms of investment process are huge. You need some flexibility, but you need to continue to implement your investment process in the way that is enabling you to deliver performance alpha on a daily basis. So it's leading to in fact, interesting question for the future of Asia in terms of ESG and product. Can we continue to propose typical conventional product, ESG integration, but at the end of the day, it will be exactly the same product as 5-10 years ago with an ESG stamp on it. Okay, ESG approved. What's the difference between that product and the one as a PM you were managing a couple of years ago? Limited. Tracking error, more or less the same type of impact, relatively limited. Or can you push and try to propose more innovative solutions around green finance, around impact investing, around focusing on the solution or the companies that are providing real concrete answer, where as a supplier of capital, maybe you should think where you are directing that capital. Do you prefer to invest in an oil and gas company, or do you prefer to invest in a clean tech company? It has implications in terms of risk-return profile, in terms of capacity, etc. I'm not saying that it should all go into that direction, but I think that sometimes innovation should be fostered, and it's really where you can establish the link, not for institutional investors, asset owners, but really for the retail, because the strength of Asia is the massive amount of people waiting and willing to invest. Give them the choice between an ESG product with a stamp or a nice product where maybe they can try to breathe more fresh air the next day, or focusing on electric vehicle, etc., etc. It's maybe interesting.
Yes, I agree. It was interesting in Davos at the World Economic Forum this year. It was almost, every panel, every engagement, the sort of the corporate and social responsibility element was very present. And I think it's interesting around ESG, you look at the motivation and the different drivers that people bring. We're seeing quite a lot of investor activism. And I imagine, when you're in an asset manager, you have this conflict between appearing or appealing to investors from the perspective of activism, obviously the conflict between integration, the pressure for short-term returns. So how do you, maybe Emily and Pru, how do you balance the tensions between all of these different motivations?
Well, if I could just jump in and respond to your previous question and then get to this one. So I'll try and keep it brief. On your point about ESG means different things to different people, I would say that generally in the mainstream asset management community, and I mean managers like us that don't align with any particular political or religious or ethical position, ESG merely it's a clunky, unfortunate acronym, which a lot of us don't even like who are in the industry. It's essentially a catch-all to talk about any factor that is not currently in the financial statements today, but which you can foreseeably see having an impact on the financial statements. And the discipline of ESG investing is the search for data that will help us to anticipate, to the extent possible, which companies are better positioned to manage those risks and capture those opportunities. It's basically everything that affects the company's value that isn't in the immediate past future. So that is my take on what ESG means. And so it's obviously ever evolving. So yesterday it was environmental pollution. Today it's climate change, and tomorrow it's data security, and it's the changing consumer demands from millennials. I mean, it's actually everything. So that's what makes it such an interesting but also difficult field. When it comes to how do we talk about ESG integration versus ESG product, I think it's very important for us as buy-side managers to educate ourselves about what are the latest market trends, to be able to educate our clients. Because I am often in a position where clients say, we want to do ESG, we want to do fossil fuel free, we want to do tobacco screening, and we want to do something to do with like low carbon. And they don't actually necessarily understand the the implementation process. So how do you actually operationalize a strategy that meets those requirements? And sometimes they actually don't have intellectual clarity about what their actual investment objective is. And I think when we talk about ESG integration, for a mainstream asset manager in our ESG policy, it's very much focused on leveraging ESG data to enhance our existing investment process as part of a fundamental bottom-up research, we're active managers, fundamental bottom-up research process, rather than adopting a particular ethical stance, which can't, by its nature, apply to our entire client base, because we serve a very large range of clients across all different geographies. But that doesn't mean that we can't and should not be using ESG data to enhance what we do. When it comes to ESG-themed products, however, a very interesting market development happened a couple of weeks ago. I think perhaps hasn't garnered as much attention as it should have. MSCI upgraded ESG ratings and scores as a factor in their risk model. Now, this is a particularly important development because if you're a quant investor, those factors become very important because you track them and you rotate in and out of those factors depending on the market cycle. And what MSCI has done is basically say, we now have enough history of data to demonstrate that ESG does rotate in and out as a factor. What that means from an asset allocation perspective is that you can allocate towards that factor consciously, the way that you would allocate towards an industry or towards a country or towards a certain style, like value, growth, quality. And so that becomes important for the rationale for why you would launch an ESG-themed fund, because you're serving that need to allocate to that factor, as opposed to doing, in parallel, ESG integration across everything that you do, whether you're a quant, fundamental investor, or a hedge fund, buy-side, whatever. So I just wanted to clarify, that's my view on that and our stance on that, and that informs how we are operationalizing ESG. When it comes to this issue about how to balance the short-term and long-term, this is another thing that gets me on my soapbox. It's a little bit of a bugbear because we do find with institutional clients also starting to move in this space and starting to think about it, they're asking for more and more information from us in mandates about how are you doing ESG integration, give us examples of engaging with companies on ESG, demonstrate how the integration of ESG factors has resulted in different performance that maybe it otherwise would have. Questions that actually do require quite significant resources and strategy for us to invest in to be able to actually do with integrity and to actually demonstrate. However, for a lot of the time, the actual structure of the mandates or the performance benchmark that we are held to is not long-term in nature. So we often find we're in a conundrum of needing to engage with companies on ESG issues because it's part of our fiduciary duty, because these issues are foreseeable, because the client's ultimate liability time horizon is infinite, maybe 80, 100 plus years, and we need to demonstrate that we're helping them with that aim, but the actual mandate structure is still an annual fee. And so this is a conversation I think that the buy side needs to organise a little bit better and say, well, we can do this for this type of fee structure, but if you really want to manage these issues over the longer term, we want to partner with you on that, but it actually means that the nature of our industry needs to shift.
Pru, before you jump in, I actually want to reframe the question a little bit for you because I think your Blackrock CEO, Larry Fink, has been pretty public, and I think many people have talked about his communication. He went out with a very powerful statement in a letter to global CEOs and a shout out to the entire financial community that society is demanding that companies, both public and private, serve a social purpose. It'd be interesting to sort of hear from you, Pru. What was the motivation behind that and why now?
Oh, Larry actually has been writing to the CEOs of probably about 2,000 companies each year for about the last 5 years, and he has sort of changed the emphasis year on year, and it has been increasingly focused on environmental, social and governance issues. And this year he did raise the issue of social purpose. And the story behind that is, and again, we're invested in probably over 12,000 listed companies, and I think from an equity perspective it's over $3 trillion US dollars, that all companies have a footprint on society in their operations. And when you look at the accounting measure for profit. It's not measuring the externalities that companies have on society. And it really is up to the boards and management to understand what that footprint is and manage that. Try and minimise those externalities, but be aware of them and address them in terms of your operations, because this will lead to, and Larry is a very strong believer of this, of longer term sustainable performance. And from the passive side, we're not worried about short-termism or what the next quarter's results are. We can be patient and we will engage with companies on these issues and really asking companies about what their purpose, and you come back to your example of Blockbuster, they completely missed what their purpose was. And it's an issue that, it's a question I'm often asking company chairmen, mainly in Australian companies at the moment as opposed to in Asia, and it's around purpose and culture. And culture is becoming a more and more important issue for boards and managements, because breakdowns of culture can lead to significant loss of shareholder value. In fact, you look at Wells Fargo, that basically lost their social licence to operate, or their licence to operate, not social licence, their licence to operate, because of this huge breakdown in value and culture. And being able to articulate purpose, not just to your employees, but also to your customers and your other stakeholders, is increasingly more and more important.
I think that's really true, and one of the things that we will soon be announcing, which I'm really proud of, is a partnership with the WEF around looking at ways to measure long-term sustainability of corporations. And I think, Emily, that really, I think, also picks up on your point, and I loved your description of ESG as sort of the integration of all of these non-financial data points really into looking at the performance of corporations. And Stephen, to you, I mean, the effort involved in that is really around vast consumptions of data. And, you know, we're living in this pivot to this machine learning age. How do you see the role of AI? I mean, it's obvious there's a huge role for it to play, but how do you think about AI applied to ESG investing?
Well, it's a good way to deal with this explosion of data that we see. There's just too much information out there for people to be able to process, going back to your stats on social media and chat on the internet and all these things that are growing explosively. Big data is getting bigger and bigger as time goes by, so people aren't going to be able to solve that problem. You have to have machines deal with it. And the good news is the machine learning and the artificial intelligence are at the point where they can keep up with that data. They're not going to do it completely on their own, but the human then gets to work in oversight rather than in trying to do it themselves. I mean, if you're trying to dig a giant hole to put up a building, you don't want people with small shovels doing it. You want large machines, backhoes, and things like that doing the digging. But there's still a person who's operating the machine, or the thing is going to run amok, as we've seen with some of these self-driving cars. So it's going to be the human and the machine acting together, and it saves a lot of resources. Instead of having to add a new analyst for every 100 companies you want to cover, you can now have those analysts reviewing the output of the machine and watching all this stuff grow exponentially.
So I really would like to open up now for questions. So there is an ability for you to submit questions on your mobile device. But for those who aren't shy and would like to stand up and ask a question, we really look forward to some questions. Do we have any questions from the audience? So while everybody gets some courage up, why don't we take a look at... For anyone on the panel, let's just take the first one, an example of how you use ESG to influence your investment decision.
Sure. In our active space, the ESG is a component of the input into the buy decision of any security. And there are examples, I won't mention the company names, where the governance score has been so low that a decision has been made not to actually invest in that stock. And one example I can think of with the Australian active portfolio has been a very, very good decision. Now, that's not to say that just because the G score is bad, a company will perform poorly, but it's just that risk that they didn't want to have that particular company in their portfolio. With our active managers, we have a screen, or they have a screen as part of their investment template called the ESG risk window. And what that does from an E&S perspective is highlight what the company is exposed to from an environmental or social perspective. And then we have a management score about how it's managed. And it generates either a black flag, a red, amber or green flag. So the analysts are required to look at what's driving those flags, what's driving a black flag. So is the company not managing that risk? Can we engage with the company and change behaviour? Is the company managing the risk but just not saying it, so our data provider's not picking it up? Or is there some issues with the data? So we have a process to ensure that in that investment process, the analysts understand what the company is exposed to from an E&S perspective and how it's managed. From a governance perspective, it's very market specific, and we've done a lot of work to highlight what governance metrics are indicators of a poorly functioning board, and that's very, very market specific. But this is an evolving process that we are reviewing all the time, and it's basically a global process for our active teams.
Do we have any questions from the audience? It'd be great to have someone stand up and ask a question. No. Francois, the questions that you can see on the monitor there, would you like to make a comment on perhaps the sort of dissection of the E, S and G between environment, social and governance? Does that resonate with you, and what's your thoughts on that?
It's maybe a characteristic of investing in emerging markets, because in emerging markets and frontier markets the same. At East Capital we only do EM and frontier just for governance matters. It's not that E and S has to be put away, but the reality of investing, meeting with the companies we are investing in on a daily basis. Governance is the first criteria, and governance will remain very important. I would love to have E and S becoming more important in this assessment, but typically when we produce our own ESG analysis, for us, we allocated up to 75% of weight on G and 25 on E and S. And it's really, with G, it's a 1 or 0 event for a PM. Either you own a stock, you've got an issue, and the stock will be suspended. For E and S, it's a much longer process when you have to concretely integrate or analyze the impact. Just 2 examples. We are analyzing a company doing an IPO, and what ESG is about and why G can be so important. We came across a situation where the CEO, chairman of the company, was in fact holding 2 passports. As a Chinese national, he's not allowed. I have nothing against Guinea-Bissau, and I have nothing against people holding a passport from Guinea-Bissau, but when they are Chinese nationals, by law, they cannot. That type of thing is typically a G event where becoming a listed company, becoming a public face of the company, you cannot afford to be in that position. This is a risk. This is how you have to qualify it. When it comes to E and S, when you think about the coal industry in China, even as a PM, run your DCF and try to justify how you will use the output beyond just basically selling coal to electricity producer, but selling coal to chemicals company. And you have to put that in your DCF in terms of capex assumption, in terms of growth outlook, if you just want to balance the equilibrium of the market. And it's when you have to step back and think, E will matter, and when and how. Can I justify that I have enough water just to run this plant? And the answer is no. So E and S will have a different impact in your investment horizon, and that's why in EM, unfortunately, so far it's still a G question.
Stephen, I want you to jump in. This data question looks a great one for you. Can you help us with the question here?
Sure. Timeliness of data. ESG is something that happens every day. It's not an annual event or something that only belongs in a report, and people are really starting to catch on with that. wherever the information is, you can scoop it up and look at it either through a machine learning approach or just human analysts who are seeing that. And we're seeing the global data providers are getting on top of that. You're seeing more importance in terms of controversy scores or reputation risk kinds of scores. But I think some people are missing the upside opportunities that go with that as well. When there are new creations, and I mean, we've seen articles come through about a company that's turning medical waste into cheap energy. Like, wow, that's interesting. I didn't know you could do something like that. And you can quantify these factors and use them as alpha factors or as risk factors. And there's definitely enough history that's available now. And we're seeing that a lot of this, because it is new information, it's really uncorrelated with other factors, especially when you start seeing it on a daily or a weekly basis. So you've got something that really helps to enhance the other pieces of information that people are working with.
Thanks, Stephen. Switching gears, there are, I'm sure, a number of people in the audience that, you know, are at the sort of early stages of an ESG strategy. So what advice would you have for, you know, funds and portfolio managers, buy-side, that are looking to actually adopt an ESG strategy? How do you get started?
Well, I think our approach from the active side was to ensure that the analysts are aware of what the company is exposed to from an E&S perspective. We don't use scores as such, we don't use ratings, and I think just coming back to what's more important, E, S or G, we look at E&S through the G lens. If you've got a competent board that understands what the company is exposed to from an E&S perspective, based on our experience, those risks will be managed better than if you've got that incompetent board. So we really do look at the G. But I think just getting that general understanding of what the company is exposed to, what is, if these risks aren't managed, supply chain risk, water risk, etc., what is the likely impact on the future value? Is that being captured in your valuation models? I think that's really a good starting point. That's sort of where we've started, and it is I know this is a word that's used a lot, it is a journey and it's a process that is evolving over time.
Emily, do you have a quick point to add to that?
I mean, I think every buy-side firm needs to seriously consider this question. I think, what is our ESG strategy? What is our positioning? What's our ability to operationalize? It needs to be in your top 5 strategic review points for 2018. Because if you don't start investing in the operational support, potentially the team members, the data sources to be able to track this better, it's going to be very difficult for you to catch up in about 4 to 5 years from now, including in Asia. So I think this is an important strategic question that needs to be discussed probably at board level, at least at management team level. And then I think what needs to be then considered is, well, where in our investment process does the ESG function sit? And I would suggest that for most managers, it really needs to be in the investment teams. So you need to be equipping the investment teams with the training and the data to be able to integrate it perhaps into their research, or if it's a quant process, they need access to the quant sources to be able to start testing different types of scores.
So I know there is a debate at times whether, you know, it sits in the investment function, does it sit in the compliance function? Does anyone have a controversial view to Emily's, or, you know, how does compliance and the investment function optimally work together? Francois?
Definitively has to sit in the investment function.
I guess no surprise that you would say that,
yes.
right?
But it has implication, in fact. And the most interesting implication is the implication of incentive scheme you put in place. Because when you look at how incentive schemes have been designed in Asia, we don't talk about UC type of incentive scheme when you run an equity product. You are level 5, 7 of risk, your long-term deferred payment will be locked in for 7 years. We are talking about remuneration practices in Asia, where sometimes in some countries you can have quarterly payment of bonuses in cash. So how do you reconciliate the ESG framework with that type of incentive scheme? You really have to put ESG at the core of the investment process in the investment team.
Can I just add just quickly? I mean, I think the compliance team has a role to play. I don't think you can actually just say to investment teams, here's our ESG policy and our philosophy, go, without having the conversations with the client service team, the marketing team, the legal and compliance team. Everyone across the board needs to understand what are we doing in this space, because the compliance team does have a backstop function to help make sure that we're actually being true to what you're representing externally about your ESG activities?
I want to finish up in sort of forward-looking mode. You know, the market and the adoption of ESG is clearly accelerating. If we were sitting here in 5 years from now, just a prediction from each of you, you know, what are we going to be looking like in Asia around adoption of ESG, and what do you think are the big swing factors that's going to drive that in the next few years? Stephen?
I think you're going to see full coverage of any traded company. You're going to have ESG information out there on everybody, both quantitative and qualitative, and everybody's going to need to incorporate this as part of their system, just like you'd look at valuation or price or quality.
I agree that with the coverage, I would like to think that the quality of the data has improved. There's a real problem in Asia at the moment with quality. One thing that I would hope does change is that boards in this region see governance in particular as a strategic issue to add long-term value and to change their boards to get better people on the boards. One question I'll ask companies, is this board the right board for the next 5 years given the potential disruptions to this business? And you've got the patriarch on there who's in their 90s, you've got a couple of sons and then a couple of grandsons on the board, and average age, I know we're not supposed to talk about where age is, probably late 70s, and that's one thing that I would like to see, and we're only going to see that if investment managers are going to be engaging with boards over that next 5-year period.
Emily?
And I think as well as what my colleagues have already said, I think we'll also see a lot more requirements by institutionals in this region for evidence of ESG integration. And if you can't demonstrate that you will actually be potentially missing out on mandates. You won't be on the final list.
Last word from you, Francois?
For me, China will be the thing that we will be talking about 5 years from now. Because so far there is nothing, but 5 years from now there will be a lot of money being allocated in China. And just keep in mind that, I don't know if the number is still right, but more or less pension schemes in China are funded at, $500 per person. So there is a massive need to build an entire ecosystem in terms of insurance. And this is where the big money will come from in Asia, combined with full access to the data in terms of artificial intelligence solutions that are not coming from the West, but maybe coming grown up domestically in China. So this is really, for me, the game changer for the future.
So look, I would like to leave it there. I think the insights have been fabulous. I think we're truly privileged to have such an incredibly knowledgeable, passionate, informed panel. And I'd like to thank you all for your contribution today. Thank you.